We're going to talk about risk arbitrage. Risk arbitrage is related to pure arbitrage, but unlike pure arbitrage, which is riskless or risk-free, risk arbitrage involves the buying and selling of two assets that have a correlation between each other, but are not the same asset as you would have in a risk-free arbitrage. Risk arbitrage is a strategy used by hedge funds and other investors in almost every financial product category, including equities, fixed income, swaps, options, and foreign exchange. We're going to look at three strategies that are used in equity risk arbitrage. The first is mergers and acquisitions arbitrage, which is where you buy the stock of the company that is the target, the company that's going to be acquired. So you buy the target, and then you sell the acquirer. The reason you do that is because two reasons. You will make more money if the acquirer is forced to pay a higher price for the target. So in many cases where another bidder enters into a takeover, the original acquirer is forced to raise their bid. So this is why you buy the target stock. The other way to profit is because generally when a company acquires another company, it's paying too high a price and the value of its stock tends to go down. So you're able to profit doubly from potentially the target stock going up in price and the acquirer's stock going down in price. This strategy works fairly well unless the acquirer decides to back out and abandon the acquisition, in which case the target stock price would go down and the acquirer's stock price would return to its previous level. Second strategy that we're going to look at is called a liquidation strategy. This is not quite an arbitrage in the sense of buying one security and selling another, but it is just buying stock once again. And the thing that you're selling is potentially the entire company. You're hoping that the company will be liquidated. So you're buying the stock, trying to get control of the company in the hopes that you can gain control, force out the existing management, and then liquidate the company either by liquidating the individual assets of the company or by selling the whole company to another acquirer. Last strategy we're going to look at is pairs trading, which is the most common type of risk arbitrage, and it involves just buying and selling two stocks that are in the same industry, so they have a high correlation because they're in the same industry, and you try to pick two stocks of more or less the same size company in the same industry, and your objective here is to buy the undervalued company and then sell the overvalued company. Once again, this strategy is only profitable if you are able to effectively be smarter than the market, be able to say that the market is overpricing the company that you want to sell and it's underpricing the company that you want to buy.